This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com. I have to have a tiny bit of talk here, which would inevitably be asked as part of portfolio and leads in. Ekaterina? I said, when we did those examples, that potentially, not always, but potentially, if you mix investments together, you're potentially able to reduce risk. And in a sense, I proved it to you with that first example. Yeah? Risks of 10 and 12, but mix them and the risk was lower. Clearly, I hope from the formula and everything, it depends how they match together, you know, this correlation. But I did think it was important that even with positive correlation, again, you can't remove risk, but you're potentially able to reduce it. And I said that's important because in real life, most investments, whether it's a project or whether it's shares, most investments tend to go up and down together. I think you all agree. Yeah? Economy does well, we all do well. Economy does badly, we all do badly. Well, the question is, why is that happening? You know, we can talk about coefficient of correlation and so on. But why is it that by mixing, you can't remove risk, but you can potentially reduce? And the reason is that when we talk about the risk of an investment, there are really two types of risk involved. Now, it's all in the notes, so I'm not going to write much on the screen, but I will write a bit and listen. If I asked you to go back to your office this afternoon and do projections for what return you think your business will make next year, all right? You know, and you did a whole spreadsheet, and obviously you've no idea, but you might say, well, it might make 10%, it might make 15%, and so on. You agree? And you did a whole range of possible scenarios. There are two things you'd think about. One thing, obviously, is the economy. You've no idea how the economy will perform next year. You might think it'll do well, but it might, you understand me? And so you might come up with a whole range on a spreadsheet, I think you know what I mean, and say, if the economy grows by 5%, we expect these returns. If it goes down 5%, these returns. Would you agree? And you can come up with a whole range of different possibilities. There's risk, you know? And of course, that's completely out of your control. Clearly, whatever business you're in, you're going to be affected by the economy. You know, depending on the business, you might be affected enormously by the economy. Other businesses, not as much, you know. But all of you are affected by economic factors, and that's outside your control. Additionally, though, one more thing. If all three of you were in the same type of business, so far you'd all be coming up with the same range of returns. Would you agree? You agree, Reda? You're giving me an awful face.
Yeah? Just listening.
All right. However, so that's one element of the risk. Yeah? Every business is different, but that's risk due to economic factors like, what's the rate of inflation next year? Obviously, it'll affect all of you. What's going to happen to the exchange rate against the dollar next year? You know, it may have hardly any effect at all because you don't trade abroad. It may have a big effect, but we're all affected, you know. And all similar businesses are affected the same way. However, the other factor you'd have to consider are factors specific to your company. Now, what I'm getting at, suppose you're all telephone companies. As far as economic factors are concerned, you're affected in the same way. But if her company has just got a new managing director, some new whizzy person, in a sense, it creates a bit more risk. He might turn out to be brilliant, and she gets higher return, steals business, so she gets higher and you all get a bit lower. Or he may turn out to be a disaster. You understand me? But it creates that little bit more risk. But that's specific to her company. Economic factors affect you all the same. But her company's a bit more risky because of something in that company. And again, risk. He might be brilliant. She does better than the rest of you. He might be worse. Oh, I mean, it's fairly textbook stuff, the examples I'm giving. But Ekaterina's company, they've had dreadful problems with the employees this year. They've all been on strike. That makes her more risky. You know, this year, things may be sorted and they do better. This year, they may carry on striking and they do worse. But it's a factor particular to her specific company. Are we clear? So, we're saying there are two bits to the business risk. I'm just going to sort of summarise here. It is typed. But when we talk about business risk, when you go to the office and do these projections, one element of it is general economic factors. Things like the rate of inflation. Yep. And we call this systematic risk. The other name for it, and in the past both words have been used, the other name for it is market risk. All right? This risk exists in all companies. I said a moment ago, whatever your company does, they are affected by changes in exchange rates. But the level of it depends on the sector, the type of business. If your business is the type of business that trades a lot abroad, if you're an oil company and there's a lot of foreign trade, you'll be affected to a high degree by exchange rates. If you've no foreign trade, you might be affected hardly at all. So we're all affected. Affects all companies, but the level is different in different sectors. Now again, without me writing an essay, are you all clear what I'm getting at? So oil companies may have a different level than a building company, but all building companies, the level will be similar. All oil companies, the level will be similar. True? Now, if you are writing, leave just 2 lines, because I want to add something later. But that is the first type of risk. But the other type of risk in a particular business, well, we call unsystematic risk, or the other word is company specific. And this is, if you like, extra risk due to factors in the specific company. And again, I'm almost finished. I'm sorry all this chat here, but it's too important. Factors due to factors in the specific company, things like the quality of management. And I don't need write down, it's implicit. But every company there is different. You've all got all your companies have its own internal factors, which tend to make it more risky, but for completely different reasons in each of you. But I'm saying if I'm looking at any business, the total risk is a combination of the two factors. All right? General economic factors, oil company, telephone company, etc. But on top of that, specific risk because of the way your individual company operates. Now, am I making sense there? Well, the real important thing is this. And then a quick look at the little picture which illustrates it. The really important thing is any company I choose to invest in, I forget projects for the minute, it's the same story, but if I'm thinking of buying shares, there's nothing I can do about this. Any company, if I invest in a company in this country, keep to this country for the minute, I'm at risk due to how well the economy in this country behaves. You agree? All right, some shares have less, some shares have more, fine. If there's more risk, I want a higher return, less risk, a lower return. But I can't sort of eliminate it. If I choose to invest in this country, I have to accept the risk of the economy in this country. So this risk here, it cannot be removed Do you agree? But of course, I can choose what level I want. If I don't want much risk, I invest in companies that don't trade abroad. If I'm prepared to accept higher risk, I'll invest in companies that do trade abroad. You with me? So we can't remove it, but the level depends on the type of business chosen. Now I'm nearly there, but are you still with me? Sorry, my writing's appalling. However, the other risk we can do something about. Because if I chose simply to invest in Natalia's company, I've got the extra risk because they've just had a new managing director. Might be brilliant, might be bad, there's risk. Equally though, if I invested in Ekaterina's company, she's got more risk. They've had a lot of strikes. She might be bad. Yeah? But if I chose to invest in both companies, then that risk, potentially, we can start to cancel out. In an extreme case, if you're all in the same industry, you've all got the same underlying risk, systematic, then your managing director, if he does well, she gets a bigger return, you all get lower, you lose business. If he's bad, she gets lower and you get more. True? But if I invested in all of you, it balances out, you know. One does better, one does worse, that risk disappears. You all with me here? The idea that it's this risk, the risk specific in individual companies, this risk can potentially be removed by diversification. And I think you know the word, but what I mean by what I mean by that word I've just written is by mixing investments or creating a portfolio. That's virtually the end of the chat. But it is critical. I may have mentioned a bit of it at F9. At P4, it's very likely to expect you to explain properly. You know, maybe have a portfolio numbers question. Well, it doesn't really matter whether you understand, you know, do the formula. But then, part B, I should explain what's happening. And you see, two things. Firstly, it's stating really what I think is common sense. You know, if your mother came to you, your mother's just run the lottery, she's got $10,000 and she wants to invest it, and she wanted to buy shares, surely, I think you'd tell her, common sense, you know, no theory, don't risk putting all your money in one share, spread it, you know, and then if one collapses, hopefully others are doing... You understand me? It's standard advice. Well, you know, all we're doing is putting it more formally. Your mother might spread and invest in 10 different shares. There's still risk. The economy might collapse next year and she loses on all of them. The economy might boom next year and she gains on all of them. She's got to accept that. If she invests in shares, she's got to accept that there's a risk due to the economy. But if she'd put it all in one share, she's at much more risk. You would advise her to spread it. And then again, if one company does badly, hopefully some other company's doing well, you know, and it cancels out. You see the point? And secondly, that example we had, look at it for one... Well, sorry, I'm making you go backwards and forwards, which is bad. But do you remember that example we looked at earlier, where we invested, we were in two bits. One had a risk of 10, one had a risk of 12. They were positively correlated, which is what happens in real life. But by mixing them, we were still able to reduce the risk. Well, it's because of that reason. You could never remove the risk, because there's always the risk of the economy, the systematic. But you're potentially able to remove the unsystematic risk. Well, I hope I've already said enough. All right? And just to wind that up, if you turn to page... What chapter were we on, please? Will we? Oh yes, I've put a piece of paper in. If you turn to page 35, where all that's typed up. You know, I'm sorry chatting when it's typed, but it's just critical. Other bits I will leave you to read, but it really is fundamental, this. But that graph there is only illustrative. You'll never need to draw it. But I don't know, if you're asked to write about it, it may... I often think it's a better way of writing. But they say that basically that graph... Sorry, I'd better just make sense of it. This graph is showing the total risk. Here is the number of shares. It's saying if you just invest in one share, well, you've got a lot of risk. All the risk, the systematic, the unsystematic. You've got all the risk. But if you start adding more and more shares, creating a portfolio, yep, then because of what I'm saying, you're potentially able to reduce the risk. However, although potentially you can remove the unsystematic, you're always at risk due to the economy. That can't be removed. And so the ideal would be to reduce the risk to a minimum. The minimum will be the systematic risk. That cannot be removed. Have I made that clear? If you choose to invest in this country, I don't care where you invest, you're accepting risk. The level of it will depend on the type of shares you've chosen. You know, if you've chosen lots of companies that don't trade abroad, the level might be lower. So the level depends on the types of shares, but you can't remove it. But what you can remove is the unsystematic. And again, any sensible person, if you can carry on getting the same return with less risk, that has to be worthwhile. All right? Now, have I made sense, please? Yeah, Katerina?
Yes.
It is making sense. And that's what portfolio theory is saying. It's saying that any investor should spread their investments, because by doing it they can potentially reduce risk without losing return. That's all it's saying. Okay, some people say, well, my mother can't afford to spread her investments. But you can buy unit trusts, mutual funds or something. We call them unit trusts. Where you're all aware, I think, even if you haven't much money to invest, so you can't diversify yourself, put it into a unit trust mutual fund, they collect it, they spread it for you. So we're all capable of spreading, if you're with me. And by diversifying here, again, we're potentially able to remove that risk, to reduce it. Okay? People have done studies, there's no need to write this down, but they said if you invest in something like 1620 shares, you're able to remove something like 95% of the risk. Yeah? So it's that sort of order. But finally, in the ideal situation, when you have removed the unsystematic risk, we say we've a well-diversified portfolio. That's word is very likely to be mentioned in the exam. A well-diversified portfolio, it means all the unsystematic risk is removed. And therefore, of course, the only risk is the systematic risk. Okay? So I don't know why I keep saying sorry. Because I'm not really sorry at all, but you know. I know it is a few minutes chatting, but it's one of the most important chats of all. What's the matter, Retta? Oh. No, it is astonishing. I mean, that's why people are frightened of this exam and why it gets appalling pass rates in the rest of the world. People go in the exam learning formulae. You know, we can all learn a formula and stick figures in. But there is written. And there are far too many people who have absolutely no idea what they're doing. You know, and capital asset follows immediately from this. They've no idea what they're doing. So the minute they're asked to write about it, they just stare at it. Or even with the numbers, if the numbers aren't immediately obvious, if they don't know what they're doing, they don't know what numbers to use, you know. So I won't go on any more there, but I do hope I've made it clear. Think about it. If I have, great. If I haven't, when you've had a think, chat with me. But I mean, again, we'll see what the new examiner's like, but the old one, as he says he'll be like, almost every exam, some bit, at any rate, of that discussion was relevant. The nature of the risk. Okay? However, the follow-on from that, we assume, accepting these portfolio questions, we assume, when we come later back to NPVs and things, we assume that our shareholders are well diversified. All right? And if we've got well diversified shareholders, or just one individual, if they're well diversified, the only risk you're interested in is the systematic risk. Would you agree? So if I'm a well-diversified shareholder and I'm thinking of buying shares in XYZ, if I'm already well-diversified, any unsystematic risk in XYZ is irrelevant. Agreed? It's a systematic. However, I've already said the level of systematic risk is different in different types of business. Oil companies more risky than telephone companies or whatever. And therefore, I will write one more line down. For well-diversified investors, it's the level of systematic risk determines the return required. If I'm well diversified, risk matters, but I'm no longer interested in the total risk of a share because some of it's unsystematic. All I'm interested in is the systematic risk, which I can't get rid of. The more systematic risk, the more return I'll want, and vice versa. People will accept risk if they get enough return. Okay? Which is really all capital asset pricing model's saying. Capital asset pricing model, in a moment, a bit revision, but some new things as you'll see. Capital asset pricing model says, assuming investors are well diversified, they say it's the level of systematic risk in an investment determines the return the investment will give. Now, the level of systematic risk will determine the level of risk there is. That's the level of return we want. Okay?